AI in trading sounds like one thing. It's actually 6. Here's which ones help and which are scams.
When people say AI in trading, they're actually describing 6 completely different activities. At the top end, Renaissance Technologies' Medallion Fund, roughly 40% net annual returns for 3 decades, closed to outside money since 1993. At the bottom end, a $99 Telegram bot promising autonomous profits while you sleep. Same 2 letters, nothing else in common. The reason retail expectations are so badly broken is that the entire stack, institutional quant ML, bank execution algos, alt data hedge funds, retail screeners, ChatGPT research, and AI signal bots get sold as one category. It isn't. 3 of those layers are real and powerful. 2 are useful but limited. 1 is mostly marketing. Let's pull them apart and figure out which ones you can actually touch. Start at the top. Renaissance, 2 Sigma, AQR, DE Shaw, Jump Trading. Medallion alone reports gross returns of 60 to 80% per year, net around 40% for over 3 decades. That's not a typo. And here's the part that matters. You cannot access it. Medallion has been closed since 1993. The mechanism is brutal. The strategy is capacity constrained, capped at roughly $10 billion, because above that level, it erodes its own edge through market impact. It exploits micro inefficiencies invisible to human traders on intraday timescales across thousands of statistical features. Push more capital through and the inefficiencies vanish. The publicly accessible Renaissance funds, RIEF, RIDA, Ridge, underperform substantially. So when an ad implies you can trade like the pros, remember, the actual pros employ hundreds of PhDs in mathematics and physics, sit on proprietary datasets, and still cap their best strategy at 10 billion. You are not catching that bus. Layer 2, bank execution and market making. JPMorgan, Goldman, Morgan Stanley. They've been running algorithmic trading for over 30 years. VWAP, TWAP, smart order routing, market making in equities, FX, and treasuries. Citadel Securities, Virtu, Jane Street. They dominate retail order flow. Layer 3, alternative data. Hedge funds spend billions a year on satellite imagery counting cars and retailer parking lots, anonymized credit card panels revealing earnings surprises before the reports come out, geolocation foot traffic data, web-scraped pricing. Here's the mechanism worth understanding. Institutional alpha hasn't collapsed to zero precisely because alt data raised the barrier to entry into the tens of millions per year. Retail cannot buy a satellite feed. The retail equivalent, reading Reddit before buying meme stocks, is real, but that information sits on every screen within hours and gets arbitraged away just as fast. 3 layers in. Institutional AI is real, durable, and completely out of reach for you. Now the layers you can actually touch. Trade Ideas does real pattern recognition on US equities, useful for surfacing breakout candidates and momentum names. BlackBoxStocks scans options flow and flags unusual activity. OptionStrat runs ML-driven probability calculations on option structures. FinChat summarizes filings and earnings calls. Schwab StreetSmart Edge, Fidelity's Active Trader Pro, Interactive Brokers Research Wizard all run ML screening tools inside the platform you already pay for. Here's the pattern across every legitimate one. They help you think faster. They do not replace your judgment. Trade Ideas surfaces candidates. You still pick the trade. BlackBoxStocks flags flow. You still interpret it. The moment marketing flips from helps you screen faster to trades autonomously while you sleep, that's the line between useful and fraudulent. Layer 5. ChatGPT, Claude, Gemini. Generative AI as a research assistant. Since 2023, this has become standard kit, and the wins are very specific. Paste an earnings transcript. Ask for the 3 things management emphasized and the 3 things they downplayed. Summarize 10K risk factors. Explain implied volatility skew in plain English. Draft a written trade plan with entry, target, stop, and risk rules before you place anything. Generate PineScript for TradingView or Python for backtesting. Those are the real wins. The losses? Predicting prices. LLMs have no predictive ability on financial time series. None. Their training data has a cutoff. They cannot see live markets, and they hallucinate quantitative facts with total confidence. Tax advice? They get it wrong constantly. Position sizing. They'll produce numbers that look reasonable and aren't optimized for your capital, your risk tolerance, or your correlation structure. The honest rule? LLMs accelerate research. They do not generate alpha. And now the sixth layer, the one that funds half of finance YouTube, AI trading bots. The marketing script is identical across hundreds of products. Our AI achieved a 92% win rate, backtested on 10 years of data, used by thousands of profitable traders. Just deposit and let the bot trade. Almost without exception, here's what's actually happening underneath. The backtest periods are cherry-picked. They show one good year and hide the year it blew up. Forward test results are absent or unaudited, when a genuine edge would be audited annually by a Big Four firm. The underlying strategy is usually a martingale, a grid, or a scalper, systems that print money in calm markets and detonate in a crisis. Affiliate revenue means influencers get paid to promote regardless of whether you lose. And a meaningful share are outright Ponzi structures with fake performance dashboards. The SEC now has an explicit enforcement category for this. They call it AI washing. The FCA has issued warnings. The CFTC has prosecuted operators. The rule is simple. If a product cannot produce a multi-year, independently audited track record, the burden of proof is not met. It does not matter how polished the video is. And the academic evidence backs this up. ML models can extract some predictability on rich feature sets, but the effect sizes are small. Out-of-sample performance degrades substantially. Transaction costs eat most of the alpha. Surviving strategies are low sharp and capacity limited. Survivorship bias is everywhere. Failed quant funds disappear from databases, so published results systematically overstate what's actually achievable. Regulators are catching up. The EU AI Act categorizes certain financial services AI as high risk. ESMA reaffirmed in 2024 that MiFID II investor protection rules apply regardless of technology. FINRA Notice 21-08 made clear that existing suitability and supervision rules cover AI products. Anything offshore, anything unlicensed, anything that ducks those frameworks, that's the gap where the scams live. So where does this actually leave you? Remember the 40% medallion number from the start? It doesn't matter because you can copy it. You can't. It matters because it tells you who your competition is at the short horizon end of the market. The rational response is not to fight Renaissance with a $50 monthly subscription. It is to pick strategies where their advantage is least relevant. Long-term value, broad diversification, or short horizon discretionary trading at scales they ignore. Use LLMs for research and writing. They make you faster at understanding and articulating. Use legitimate screeners like Trade Ideas or FinViz for triage. Use the research already built into your broker before paying for anything third party. Avoid autonomous bots unless they hand you an audited multi-year track record and you understand the strategy mechanically. And here's the part that does not move. The 70 to 85% retail loss rate published by ESMA, the FCA, and the CFTC does not change when traders add AI to the stack. Small position sizes, written rules, a journal, accepting losses. That's the actual edge. AI is a faster set of tools, not a replacement for any of it. The line worth remembering, AI augments your process. It does not outsource your judgment.
AI augments your process. It does not replace judgment. Full breakdown linked in the description.